what if I told you that having a pristine, flawless 800 credit score isn't actually enough to get the best credit
Yeah,
cards?
it's wild, but it's true.
Right. In fact, if you don't know exactly when to apply, that perfect credit score might actually, guarantee you get rejected.
Absolutely.
Welcome to the deep dive. Today, we are just skipping the pleasantries and jumping straight into the mission, which is mastering the art of credit card velocity.
Right. Velocity is the key word here.
Yeah, and we are pulling our insights today from a genuinely fascinating piece of research by Troy Johnston over at StackEasy.ai. It's titled Credit Card Velocity Strategy: How to Time Applications.
It's a great piece. Really breaks down the math.
It really does. So we are going to figure out the optimal timing, the sequencing, and the hidden back-end algorithms
Yeah.
that you need to navigate to apply for multiple credit cards, without entirely destroying your financial profile in the process.
And the stakes here are incredibly real, especially for anyone listening who, actively optimizes their
For
finance.
sure.
Because building what we call a credit stack, which is basically a strategic diversified portfolio of different credit cards for like various travel rewards, purchase protections, and cashback benefits, it's this ultimate balancing act.
A total tightrope walk.
Exactly. Because if you play it too safe and apply too conservatively, you are just leaving massive amounts of valuable credit and, frankly, life-changing sign-up bonuses sitting on the table.
Right. Which nobody wants to do.
But if you apply too aggressively, that is when the system severely penalizes you.
Yeah, that's the scary part.
It is. You risk triggering automated fraud alerts,
Yeah.
tanking your hard-earned credit score, or, worse, getting completely and permanently blacklisted by the major global lenders.
Okay, let's unpack this, because before we can even get into the specific timing strategies and calendar hacks, we really need to understand the actual math of what happens behind the scenes.
The foundational stuff, yeah.
Right. What happens the very millisecond you hit submit on a credit card application?
It's immediate.
Yeah, and if you follow this space, you already know that every single time you apply, the issuer pulls your credit report, which creates a hard inquiry.
Right. Hard pull.
And that single action typically drops your FICO score by about 5 to 10 points.
Exactly. And, while 5 to 10 points might not sound catastrophic in isolation.
Especially if you have a great score to begin with.
Right, exactly.
Yeah.
But you have to consider the timeline of that damage. Because those hard inquiries, they stay glued to your credit report for a full 12 months.
Wow. A whole year.
A whole year. But Johnston's research points out a really crucial detail here. Their negative impact is most severe in the first 3 to 6 months.
Okay.
That window is when lenders view you as the most volatile, like the most credit hungry.
Right. But
Mm.
there's a secondary mechanism at play here that really stood out to me in the article.
Oh, the average age of accounts?
Yes. Opening a new card actively lowers your average age of accounts. And the length of your credit history makes up a massive 15% of your overall FICO calculation.
It's a huge chunk.
It is. And I like to think about it like this. It is exactly like adding a fresh 18-year-old rookie to a veteran sports team.
Oh, that's a good way to look at it.
Right. You might have a team of seasoned players who have been in the league for a decade, holding down a great average age. But the second you sign that rookie who has 0 years of experience, the overall average experience of the entire team instantly drops.
That is a perfect way to visualize the algorithm.
Yeah.
You are introducing a zero variable into a seasoned mathematical equation.
Yeah.
So your 5-year average age literally drops to a 3-year average overnight.
But this brings up a massive question for me. I actually have to push back on this entire concept for a second.
Okay, let's hear it.
If getting a new card guarantees a 5 to 10 point drop from the hard pull, and it actively ruins my average account age, which is 15% of my score,
Right.
why do it at all? Why shouldn't you just get one reliable, decent rewards card, hold on to it forever, and just protect your perfect FICO score like a Fabergé egg?
It is a totally valid question. And honestly, it is the exact trap a lot of really smart consumers fall into.
They just get too defensive.
They get highly protective.
Yeah.
The fundamental problem with the one card forever strategy is that your total available credit remains entirely stagnant.
Okay.
To build a large, robust financial profile, new cards are mandatory because of another metric, which is your credit utilization ratio.
Right. The amount of credit you are actively using versus the amount you actually have available to you.
Exactly. Let's break down the math on this really quick. Say you only have one card, and it have a $10,000 limit.
Okay, 10,000.
If you spend $2,000 a month on living expenses, your credit utilization is 20%.
Makes sense.
The FICO algorithm sees that and thinks, okay, they're using a decent chunk of their available rope.
Right.
But if you strategically open 2 more cards, and suddenly your total combined credit limit jumps to, say, $30,000.
Oh, wow. I see where this is going. If you are still only spending that exact same $2,000 a month, your utilization ratio plummets from 20% down to like roughly 6.6%.
Precisely. And a utilization ratio under 10% makes the FICO algorithm incredibly happy.
It's like the sweet spot.
It really is. It signals that you have access to vast amounts of credit, but you possess the financial discipline to not actually rely on it.
That's fascinating.
So the secret here isn't avoiding hard inquiries altogether. It is about velocity management.
Right. Pacing it out.
You are intentionally spacing your applications out so that your credit score has the necessary time to heal before you take the next hit.
So you accept the temporary dip, the rookie on the team, basically.
Exactly. You accept the rookie because you know the long-term mathematical gain of having a massive total credit limit will ultimately bulletproof your profile.
It's calculated damage for long-term growth.
Perfectly said.
Here's where it gets really interesting, though, because you could do all of that perfectly. You could have a flawlessly healed, sky-high credit score, a utilization ratio of 1%, and you could still get instantly rejected.
Oh, absolutely. Without question.
Which is crazy, because knowing that inquiries need to be spaced out is really only half the battle here.
It's just the baseline.
Right. We have to talk about the boss levels of this game, because the banks themselves have strict, unbending back-end rules that override even a perfect FICO score.
Yeah, they do not care about your 800 score if you break their internal rules.
Exactly. And the big one, the one everyone listening absolutely needs to know about, is the Chase 524 rule.
Ah, yes, the infamous 524. This is really the cornerstone of all credit velocity strategy.
The research stresses this so heavily, Chase will automatically, without a human even looking at it, deny any application if you have opened 5 or more personal credit cards in the past 24 months.
It's a hard-coded wall.
It is. And here is the kicker that trips so many people up. That is 5 cards from any issuer, not just Chase.
Right, it's not just Chase cards.
So if you are listening to this right now and you opened 2 cards with Capital One, 2 with Citi, and 1 with Discover in the last 2 years, you are entirely locked out of Chase.
Locked out completely.
And that hurts, because Chase holds the keys to some of the most valuable, highly sought-after travel cards in the entire ecosystem.
Like the Sapphire Preferred and the Reserve.
Exactly. I instantly picture this like a strict VIP club bouncer.
Oh, that's a great analogy.
It absolutely does not matter how good you look, or in this case, how high your credit score is. If that bouncer sees stamps from 5 other clubs on your hand from the last 2 years, the velvet rope is not opening for you.
You aren't getting in.
You just aren't.
What is fascinating here is the underlying logic of why the banks enforce these rigid thresholds.
Why do they? Because it seems like they're turning away good customers.
Well, banks use these rules to aggressively weed out what the industry calls churners.
Churners.
Yeah, these are consumers who are highly educated in the credit game, and they're basically just hunting for lucrative sign-up bonuses.
So they grab the points and run.
Exactly. They extract all the value and move on without ever becoming profitable long-term customers for the bank.
Ah, I see.
From the bank's perspective, someone opening 5 cards in 2 years isn't a loyal customer seeking a real financial relationship. They are a liability. They are an expense.
So you really have to, hoard those Chase approvals. You can't just throw them away.
Precisely. Strategic planners will actively save their Chase slots for very specific high-value travel goals.
I map it out.
They map it out on a literal calendar, because if you carelessly burn your 5th slot on, like a random retail store card just to save $20 at the cash register.
Oh, man, don't do that.
Right. If you do, you are locked out of premium Chase travel rewards for 2 full years. There is no appeal process. The algorithm simply says no.
And Chase isn't the only one playing hard to get either. American Express has a completely different but equally intense set of rules.
Amex is a whole different beast.
Yeah, Johnston's data highlights their once-in-a-lifetime rule for welcome bonuses.
Which is exactly what it sounds like.
Right. If you get a sign-up bonus for a specific Amex card, you can never get it again.
Ooh,
Ever.
it's harsh.
There is no waiting period. There's no reset clock after 5 years. It is a permanent disqualification.
Yeah.
Plus, they are incredibly sensitive to application speed. The article says they require you to wait at least 90 days between applications.
Minimum.
Yeah, if you move faster than that, you aren't just looking at a denial. You risk them actively shutting down the Amex accounts you already have open.
And this raises a really crucial point about the mechanics of relationship banking.
Okay, what do you mean by that?
Well, you see, unlike Chase, which relies on a hard, easily verifiable mathematical cutoff like 524,
Right.
American Express relies heavily on internal predictive algorithms. They are looking at the overall health and behavior of your relationship with them. It is not just about your FICO score.
Wait, so what else are they actually looking at?
Oh, they monitor your daily spending velocity. Like, do you pay your balance off multiple times a month, or do you just let it sit until the due date?
Wow, they get that granular.
Very. Are you manufacturing spend, or is it organic?
Mm.
If you apply for 3 Amex cards in a single month, their algorithms don't just see a credit-hungry consumer.
What do they see?
Their predictive models see a potential massive default risk.
Oh.
They assume you have lost your job or are facing an undisclosed financial crisis, and they will pull the plug entirely to protect their assets before you can default.
Wow. Okay, so if Chase and Amex are actively hunting for people moving too fast, we obviously can't just wing this.
No, absolutely not.
We need an actual system to outpace their algorithms. But as I was looking at Johnston's data on exactly how fast we are actually supposed to apply, there is a massive contradiction staring us right in the face.
Okay, let's break it down. What did you find?
Well, on one hand, the research clearly states that applying for more than 2 to 3 cards in a 6-month period significantly increases your rejection risk.
Right.
It emphatically tells you to space applications 3 to 6 months apart.
That's the standard advice, yeah.
But then you look at the actual optimal velocity strategy he proposes later in the piece, and it recommends applying for 2 to 3 cards a month during the early foundation building phase.
Yep.
How do we reconcile that? Which is it? Do we space them out 3 to 6 months to avoid rejection, or do we rapid fire 2 to 3 a month?
It definitely looks like a massive contradiction at first glance,
It really does.
but it actually reveals the core secret of advanced velocity strategy. You have to separate your entire financial journey into 2 distinct, uncompromising phases.
Okay, 2 phases.
Yes. The early phase, they talk about doing 2 to 3 cards a month. That is a high-risk, high-reward sprint.
Sprint. Got it.
When you have a thin credit file, but you are in good standing, you can aggressively build a massive base of available credit very quickly before the bank's reporting systems catch up to you.
Oh, I see.
You are intentionally taking on the heavy damage of those hard inquiries to build immense momentum.
But you obviously can't keep sprinting forever.
Exactly. Maintaining that speed is completely unsustainable. If you try, you will hit the Chase 524 wall immediately.
Damn! Game over.
And you will trigger those algorithmic tripwires at American Express that we just talked about.
Right.
So, to survive long-term in the credit stacking game, you must pivot from that aggressive early phase into the maintenance phase.
And what does that look like?
That maintenance phase is where the 3 to 6 month spacing rule becomes your permanent, lifelong reality.
Oh, okay, that makes a lot of sense. It is like sprinting to get off the starting line in a race, but then settling into a marathon pace so you don't completely collapse halfway through.
Perfect analogy.
And speaking of surviving that initial sprint phase, there is a tactic in the research that feels like a legitimate, almost borderline illegal cheat code to help minimize the FICO damage when you are being highly aggressive.
Oh, I know exactly what you're going to say.
It is called the same-day hack.
Ah, yes. This is a vital, incredibly potent tactic for that early phase.
The research advises that you should apply for multiple cards from different issuers on the exact same day.
Yep.
And the mechanism here is just wild to me. Hard pulls from the same day often combine into a single inquiry on your credit report.
It's true.
Let's play this out so everyone gets it. Say you want 3 new cards. If you apply for one on Monday, one next Wednesday, and one 3 weeks later, your FICO score tanks.
You take 3 separate hits.
Great. You take 3 separate 5-point hits. But if you apply for all 3 in a 3-hour window on a Tuesday afternoon, you literally trick the credit bureaus into only registering one impact event.
Yeah, you do.
How is that even possible?
It's a brilliant loophole, honestly, and it's born out of how legacy financial systems operate.
Okay.
The credit bureau's back-end systems are fundamentally designed to group identical behaviors on a single day to account for consumer rate shopping.
Rate shopping, like for a car.
Exactly. Think about getting an auto loan or a mortgage. If you go to 5 different car dealerships in a single afternoon to find the best interest rate, each dealer pulls your credit.
Right, and they shouldn't punish you for being a smart shopper.
Exactly. The Bureau's algorithms generously assume you were looking to buy one car, not 5 cars. So they combine those 5 pulls into a single penalty, to be fair to you.
That is incredible.
Savvy credit stackers leverage this exact same back-end logic.
Oh, wow.
By stacking applications on the same day, you secure tens of thousands of dollars in new credit lines, but you only pay the FICO penalty for one single inquiry.
So, what does this all mean for the listener?
Well, it changes how you approach everything.
Right, because we have all these rigid rules, these distinct phases and back-end hacks, and because applying too fast can obviously spiral out of control and ruin your profile, we need a tangible, everyday system to manage this velocity.
We do.
We need to shift from being a reactive consumer to being a strategic planner.
The shift from reactive to strategic is the entire ball game here. The data is very clear. You have to completely stop reacting to random card offers you see online, on social media, or, in your physical mailbox.
Right. No more applying just because an airline sent you a shiny mailer with a picture of a beach on it.
Exactly. You need to build a literal, written application calendar.
Calendar. Okay.
You start by auditing your past 24 months, pull your credit report, exactly how many cards have you opened, where do you currently stand on the Chase 524 rule.
You need to know your baseline.
Once you have your undeniable baseline, you define your specific financial goals. Like, are you optimizing for domestic flights, international business class, or just pure cash back?
Right.
And then you map out your applications months in advance, deliberately building in massive amounts of buffer room.
Wait, buffer room for what exactly?
For the unexpected friction of the banking system.
Okay, like what kind of friction?
Well, what if you get denied and have to spend a week calling the reconsideration line to plead your case?
Oh, that's true.
Or what if a premium card requires you to spend $4,000 in 3 months just to unlock the sign-up bonus? Your calendar needs to deeply account for that pacing.
Right, the minimum spend requirements.
Yes, because if you apply for 3 cards that all require a $4,000 minimum spend in the same exact window, you are suddenly forced to spend $12,000 in 90 days just to get your points.
Which is insane for most people.
It leads to manufacturing spend, unnecessary stress, and potentially crippling debt.
And as much as we need to know exactly when to apply, Johnston's research is incredibly stern about knowing exactly when to slam on the brakes entirely.
Yes, the hard stops.
There are absolute hard stops in this strategy. Like, if you get denied, do not immediately reapply out of frustration.
Never do that.
If your score drops significantly, pause and let it heal. If you have recently opened several cards in a row, just wait.
Yep.
But the biggest hard stop, the one that immediately caught my attention in the article, is the mortgage warning.
Oh, this is so important.
The data dictates that you must completely stop applying for any new credit 6 to 12 months before applying for a major loan, like a mortgage or an auto loan.
Yeah, if we connect this to the bigger picture, this is where velocity strategy intersects with major real-world life events.
The stakes go way up.
They really do. And the consequences of getting this wrong are incredibly severe. I need to understand that mortgage underwriters are operating on an entirely different level of scrutiny than automated credit card algorithms.
Because they're actual people.
Exactly. Human lenders are terrified of recent credit inquiries right before a mortgage application.
But why is that? I mean, let's say I have an 800 FICO score, I make a great salary. Why do they actually care if I got a new airline card last month just to get free checked bags?
Because to a mortgage underwriter, a sudden flurry of recent hard inquiries signals one of two things.
Okay, which are?
Extreme financial desperation or hidden debt.
Hidden debt.
You have to remember the time lag in credit reporting. An underwriter worries that you might be taking on massive debt that hasn't officially posted to your credit report yet.
Oh, wow. I never thought about the time lag.
Right. You might have just maxed out that new airline card yesterday to buy a bunch of furniture for the new house, and the underwriter won't mathematically see that balance until next month after they have already handed you the keys to the house.
That makes perfect sense from their perspective.
A fantastic, flawless FICO score will not save you from a terrible mortgage rate or an outright denial if the human underwriter feels you are exhibiting erratic, credit-seeking behavior right before asking them for $500,000.
Let's play that out because the stakes there are terrifying. You could literally cost yourself a 0.5% jump in your mortgage interest rate
Easily.
over a 30-year, $500,000 mortgage. That is tens of thousands of dollars in extra interest, all because you couldn't wait 6 months to get a $500 sign-up bonus on a hotel card.
It's a terrible trade-off.
That visceral reality really puts the need for a strict application calendar into perspective. You aren't just mapping out your wallet, you are mapping out your life.
It requires immense discipline. You have to prioritize the appreciating asset, the house, over the temporary perk.
Absolutely. All right, so to bring this all together, today's deep dive has made one thing abundantly clear. Credit card velocity isn't just about speed.
Not at all.
It is entirely about pacing and algorithmic empathy. You have to treat your credit profile like a carefully curated calendar.
Definitely.
You have to deeply respect the strict boundaries of Chase's 524 rule and American Express's lifetime bonus limits. And, you can use aggressive tactics like the same-day hack during your early base building sprint, but eventually, to survive, you have to settle into that 3 to 6 month maintenance rhythm.
That's the key to longevity.
And above all else, always hit the brakes at least 6 to 12 months before a major life purchase.
It is a highly complex system to navigate, but mastering it gives you incredible financial leverage.
It really does.
But, looking at all this through a macro lens,
Mm-hmm.
think about the Chase 524 rule and the Amex once-in-a-lifetime rule. Think about the application calendars we are building. We spend all this time, all this intense mental energy trying to hack the banks with these elaborate velocity strategies.
We really do. We treat it like a game.
Right. We group our applications on a Tuesday afternoon to trick a back-end algorithm. We think we're outsmarting them.
Uh-huh.
But by forcing us to strategize our actual lives, to delay our major purchases, and to mold our spending habits entirely around their specific arbitrary application rules, are we really hacking the banks, or have they successfully hacked us?
Oh, man, that is a heavy, almost existential thought to end on.
Just something to think about.
Have we just gamified our own consumerism entirely to their benefit?
Maybe we have.
If you ever figure out the answer to that, let us know. Because whether you are mashing the buttons in a dead sprint or perfectly timing your combo in the maintenance phase, you are still actively playing their game.
That's for sure.
Thank you so much for joining us on this deep dive into credit card velocity. Keep auditing your calendars, keep questioning the financial systems around you, and we'll catch you on the next one.